Have you ever wondered why two people can invest in the same stock, but one panics and sells during a dip, while the other calmly buys more and gets rich? The difference isn't just knowledge. It's psychology. There's a hidden mental framework that separates the average investor from the wealthy. And it's not about predicting the market, it's about mastering your own mind. This is the one investing psychology lesson that changes everything, yet almost no one is teaching it. Welcome back to the channel. Make sure to hit subscribe and click the bell icon, because what you're about to learn could be the turning point in your entire financial life. Let's begin. 1. The market isn't rational, and neither are you. You've probably heard the phrase, the market is irrational in the short term. But here's the twist. You are too. Most investors think their decisions are based on logic and research. In reality, their portfolio is driven by emotion, fear, and social influence. Every dip in the market feels like danger. Every rally feels like missing out. But neither of those feelings reflects the actual value of an asset. This is where most people fail, not in strategy, but in behavioral discipline. The market goes up and down. That's normal. But your reaction to it? That determines your wealth. 2. Loss aversion is costing you millions. Here's something shocking. Losing $1,000 feels 2 to 3 times more painful than gaining $1,000 feels rewarding. This is called loss aversion, and it's why most people sell at the worst possible time. They feel pain, not logic. So when their stocks drop 10%, they panic sell, even though history shows that downturns are usually the best time to buy. Wealthy investors understand this psychology and use it to their advantage. They know that fear in the market is an opportunity, not a threat. But the average investor? They do the opposite. They sell low and buy high. They chase trends, and they call it playing it safe. In truth, they're bleeding money. 3. The myth of control. The average person believes that the more they monitor the market, the better their results will be. In reality, the opposite is true. The more often you check your portfolio, the worse your decisions become. Why? Because you're overreacting to noise. You weren't meant to handle this much information. The constant news cycle, daily price swings, expert predictions, it overwhelms your rational brain and activates your survival instincts. Successful investors don't obsess over the daily price. They focus on the long-term fundamentals and the quality of their decisions, not the outcome of every week. Because when you need control, you make impulsive moves. But when you accept uncertainty, you start playing the real game of investing. 4. Time horizon distortion. Ask most people why they're investing, and you'll hear something like, to be financially free one day. But here's the catch. They say they're investing for the long term, yet they act like short-term traders. They check their portfolio 5 times a day. They sell after a 5% drop. They jump ship the moment things get uncomfortable. This is what we call time horizon distortion. Your actions don't match your stated goals. The top 1% of investors operate on a different time frequency. They're not thinking in quarters. They're thinking in decades. And that shift in time perception changes everything. It makes them immune to panic. It helps them see volatility as opportunity. It makes them rich. 5. Confirmation bias kills growth. Let's say you think a certain company is a bad investment. Then you go on YouTube or Reddit, and you search for videos confirming it's a bad investment. You find exactly what you're looking for. You feel smarter. But here's the truth. You just fell into confirmation bias. This psychological trap is one of the biggest killers of growth. We don't want the truth. We want to be right. But wealth is built by people who challenge their own assumptions. Who ask, what if I'm wrong? What does the data actually say? What am I not seeing? Confirmation bias keeps you in an echo chamber. It limits your growth. And in investing, staying in the wrong mindset for too long is expensive. 6. The emotional cycle of wealth. Every investor, regardless of experience, moves through a psychological loop. Optimism, right pointing arrow; excitement, right pointing arrow; euphoria, right pointing arrow; fear, right pointing arrow; panic, right pointing arrow; despair, right pointing arrow; hope, right pointing arrow; recovery. This cycle repeats over and over. And every time you break from it, you gain power. You evolve. Wealthy investors feel those same emotions, but they don't let them decide. They've trained themselves to stay calm during fear and skeptical during euphoria. Because the emotional cycle doesn't go away, it just becomes background noise for those who've mastered it. 7. The real lesson. Your brain wasn't built for investing. Here's the ultimate truth no one teaches in school. Your brain was designed to survive, not to invest. It was wired for short-term danger, instant gratification, group behavior, emotional reactions, but investing requires long-term thinking, delayed rewards, independent decisions, rational analysis. That's why investing is hard, not because the markets are complex, but because our own psychology is flawed. Those who succeed didn't just read a few books. They rewired how they think. They built emotional resilience. They learned how to sit still when the world screamed, "Do something." So here's the lesson that changes everything. You don't have to predict the market to build wealth. You just have to stop sabotaging yourself. Master your emotions. Play the long game. Ignore the noise. And watch what happens over 10, 20, or 30 years. Because the greatest investing edge isn't a stock tip. It's not a hedge fund. It's not even timing. It's emotional control. And once you master that, everything else falls into place. If this changed the way you think about investing, leave a comment below and share your favorite takeaway. Don't forget to like, subscribe, and click the bell icon, so you never miss out on more life-changing insights about wealth, psychology, and long-term success. Thanks for watching, and remember, it's not about being the smartest. It's about being the calmest.